What if I told you that the smartest Wall Street fund managers, the ones with Ivy League degrees, Bloomberg terminals, and six-figure salaries, what if I told you that a blindfolded monkey throwing darts at a newspaper could match their performance? Sounds crazy, right? Like something a broke person would say to make themselves feel better about not investing. But this isn't coming from me. This is coming from one of the most respected economists at Princeton University, a man who spent decades studying every corner of financial markets, and what he found completely shattered everything Wall Street wants you to believe. His name is Burton G. Malkiel, and his book, A Random Walk Down Wall Street, might be the most important finance book ever written. Stay with me today, because by the end of this video, you're going to see the stock market in a completely different way, and it could literally save you tens of thousands of dollars. I'm Mono. Welcome to Mono Invest. Let's get into it. Imagine you're standing in the middle of Times Square in New York City. It's midnight, and you've had, let's say, a few too many drinks. You start walking, but here's the thing. Every step you take, you have no idea which direction your next step will go. Left, right, forward, backward. It's completely random, unpredictable. That, my friend, is a random walk. And according to Burton Malkiel, that is exactly how stock prices move. Now, before you say, Mono, that can't be right, let me take you back to where this whole story begins, because Malkiel didn't just wake up one morning and decide to be controversial. This idea has roots that go back decades. It was the 1960s. The American stock market was booming. The economy was growing. Rock and roll was taking over the radio. And on Wall Street, analysts in sharp suits were making bold predictions about which stocks would soar. Everyone believed, truly believed, that if you were smart enough, if you studied the charts long enough, you could crack the market's code. Then, a French mathematician named Louis Bachelier had published a thesis back in 1900 that almost nobody read. He studied the Paris Stock Exchange, and what he found was terrifying to the financial world. Stock price changes were statistically independent from one another. In plain English, the fact that a stock went up yesterday tells you absolutely nothing about where it goes tomorrow. This was the seed, and Malkiel took that seed and grew it into a forest. Key insight? Stock prices do not follow a predictable pattern. Each day's movement is essentially independent from the last. Now here's where it gets really interesting. Malkiel says there are two schools of thought on Wall Street that most people swear by, and he spends a huge portion of this book dismantling both of them. Let's talk about them. There are two types of people on Wall Street, and both of them think they've cracked the code. The first group, they're called the technicians, or sometimes called chartists. These are the people who stare at stock price charts all day long. They see patterns, head and shoulders patterns, cup and handle formations, double bottoms. They believe that the history of a stock's price movement can predict its future. Picture this. A technical analyst walks into his office at 7 a.m. He pulls up a chart of Apple stock. He sees that over the past 6 months, every time Apple's stock price hit $170, it bounced back up. He calls that a support level. He goes all in, betting Apple will bounce again. And sometimes he's right, which only makes him more confident. But Malkiel says, wait a minute, let's test this scientifically. He describes an experiment where researchers generated completely random stock charts using a coin flip. Heads, the stock goes up; tails, the stock goes down. And then they showed these charts to technical analysts. The analysts got excited. This one has a classic head and shoulders pattern. This one is breaking out. They were seeing patterns in pure randomness. This is what psychologists call apophenia, the human brain's tendency to find patterns even where there none exist. Malkiel's conclusion, technical analysis is essentially financial astrology. It might feel powerful. It might even work sometimes by coincidence, but it has no scientific basis. Now, let's talk about the second group, the fundamentalists. These are more sophisticated investors. They don't care about charts. Instead, they dive deep into a company's financials, earnings per share, price-to-earnings ratio, book value, dividend history. They try to find stocks that are undervalued, trading below what the company is actually worth. This sounds much more logical, right? Warren Buffett does this. Benjamin Graham, the godfather of value investing, built an empire on this. So surely Malkiel agrees with this approach. Well, sort of, but with a massive asterisk. Here's the problem Malkiel identifies. By the time you or even a professional analyst figure out that a stock is undervalued, the market has already figured it out too. Thousands of analysts are looking at the same financial reports, the same earnings calls, the same balance sheets, and they're all racing to act on that information. By the time you hit buy, the opportunity is gone. This brings us to what Malkiel considers the most powerful idea in the entire book, the efficient market hypothesis, and it's about to change the way you think about investing forever. Here's a classic joke that Malkiel references in the book. Two economists are walking down the street. One of them spots a $100 bill lying on the sidewalk. He bends down to pick it up. The other economist stops him and says, "Don't bother. If it were really there, someone would have already picked it up." That joke is the efficient market hypothesis. The idea is brutally simple. In an efficient market, all available information is already reflected in stock prices. Think about it this way. Right now, there are millions of people analyzing the stock market, hedge funds with supercomputers, Goldman Sachs analysts, MIT-trained quants, individual investors glued to CNBC. All of them, every single one, is looking for an edge. The moment any new information becomes public, an earnings surprise, an FDA approval, a new iPhone launch, thousands of traders react in milliseconds. The price adjusts almost instantly. So here's the question Malkiel forces you to sit with. If all that information is already in the price, what edge do you have? What does the average American investor know that Goldman Sachs doesn't? What can you see in a chart that a hedge fund's algorithm hasn't already acted on? Malkiel's answer, and I know this is hard to hear, is probably nothing. Now, this doesn't mean the market is perfect. Malkiel is very clear on this. Markets can be, and often are, irrational in the short term. Prices can get wildly out of whack. But here's the cruel twist. Even knowing that the market is irrational doesn't help you profit from it, because you don't know when it will correct or how it will correct. This is why brilliant economists have lost fortunes trying to short overvalued markets, only to watch those markets stay irrational for years longer than they could stay solvent. John Maynard Keynes, one of the greatest economists who ever lived, put it perfectly. The market can remain irrational longer than you can remain solvent. And Malkiel shows this through one of the most chilling chapters in the book, the history of market bubbles. Let me take you back to Holland. The year is 1636. Tulips had just arrived in Europe from the Ottoman Empire. They were exotic, beautiful, and unlike anything Europeans had ever seen. The Dutch went absolutely crazy for them. Now here's where it gets insane. People started trading tulip bulbs, the actual bulbs, before they even bloomed, like they were stocks. Prices started rising, then rising faster. People were selling their homes, their livestock, their life savings, all to buy tulip bulbs. At the peak of what became known as tulip mania, a single tulip bulb was worth more than a skilled craftsman's annual salary. Some rare bulbs sold for the equivalent of a luxury Amsterdam canal house. And then, in February 1637, the market collapsed, almost overnight. Prices crashed 99%. People who had mortgaged everything were left with nothing but worthless flowers. You might be thinking, okay, Mano, that was 400 years ago. We're smarter now. Are we? Fast forward to the 1990s. The internet was changing everything. Every company with a .com in its name was worth billions of dollars. Kids in their 20s were becoming paper millionaires overnight. The Nasdaq went up 400% in 5 years. Pets.com, a company that sold pet food online and had never turned a profit, raised hundreds of millions of dollars in its IPO. Everyone knew the prices were insane. Analysts said so, but nobody wanted to be the one to get off the ride early. Then, in March 2000, the dot-com bubble burst. The Nasdaq fell 78%. Trillions of dollars in wealth evaporated. Retirement accounts were wiped out. It took 15 years for the Nasdaq to fully recover.
And then, just 8 years later, it happened again, this time in housing. Americans were convinced that home prices only go up. Banks were handing out mortgages to anyone with a pulse. People were flipping houses they couldn't afford, convinced they'd sell for more tomorrow. Then 2008 hit, and the entire global financial system nearly collapsed. Malkiel walks through all of these bubbles, and the pattern is always the same. He calls it building castles in the air. At some point, investors stop asking, "What is this worth?" and start asking, "What will someone else pay for it tomorrow?" That's when markets become a dangerous game of hot potato, and the person left holding it when the music stops, they lose everything. The lesson? Market bubbles are driven by human emotion, greed, FOMO, and herd mentality. They have happened throughout history and will keep happening.
The only protection is understanding them. But here's the thing Malkiel is really building toward. All of these stories, the tulips, the dot-coms, the housing crash, they all prove one thing. No one can consistently predict when a bubble will pop. Not you, not me, not the experts on TV, not the hedge funds. So if we can't beat the market, what the heck do we do? That's where Malkiel gives us the answer, and it's surprisingly simple. Let me paint you a picture. It's 1975. A man named John Bogle just launched something that Wall Street absolutely hated. They called it Bogle's Folly. They mocked it, ridiculed it, said it was un-American. What did he create? The first index fund available to regular investors. Here's the idea. Instead of trying to pick winning stocks, which we've established almost nobody can do consistently, what if you just bought all of them? An index fund simply tracks a market index like the S&P 500, which represents the 500 largest publicly traded companies in America. When you invest in an S&P 500 index fund, you own a tiny piece of Apple, Microsoft, Amazon, Google, Berkshire Hathaway, all of it. You're not trying to beat the market, you are the market. And here's the beautiful, counterintuitive result. By not trying to beat the market, you beat most people who do. Let me give you the numbers, because this is where it gets really powerful. Every year, the S&P 500 research firms track how many actively managed mutual funds, the ones run by professional stock pickers with huge teams of analysts, outperform a simple S&P 500 index fund. The results? In any given year, about 80% of active funds underperform the index. Over 15 years, over 92% of active funds underperform. Think about that. You're paying a fund manager 1%, sometimes 2% annually, which on a $100,000 portfolio is $1,000 to $2,000 a year. And 92 out of 100 times, over the long run, you would have been better off just buying an index fund. And why? Malkiel explains it clearly. Number one, costs. Every trade a fund manager makes has a cost. Every analyst they hire has a salary. Every fancy office in Manhattan has rent. Those costs get passed to you, and those costs compound over time. The average actively managed fund charges about 1% per year in fees. A Vanguard S&P 500 index fund, 0.03% per year. That's 3 cents on every $100. Number two, taxes. Active fund managers trade constantly. Every time they sell a stock for a profit, you owe capital gains taxes. Index funds barely trade at all, so they're incredibly tax efficient. Number three, the math of consistency. To consistently beat the market, you don't just need to be right more than wrong. You need to be right enough to overcome your fees, taxes, and the occasional big mistake, year after year after year. As Malkiel puts it, even a small, consistent advantage is incredibly hard to maintain. The most efficient way to invest in equities is to buy and hold a low-cost index fund that tracks the market, by Burton Malkiel. Now here's something Malkiel addresses that I know many of you were thinking. But Mono, what about Warren Buffett? He beats the market all the time. Yes, and Malkiel acknowledges this. Some investors are genuinely skilled. Buffett is one of them. But here's the catch.
In a market with millions of participants, some people will beat the market just by random chance. If a million people flip a coin 10 times in a row, some of them will get heads every single time. Does that make them great coin flippers? No. The question Malkiel asks is, before the fact, can you identify which managers will be the Buffetts? The research says, no, you cannot. Past performance does not predict future results. You've read that disclaimer on every fund prospectus. Malkiel proves mathematically why it's true. Okay, so Malkiel has told us what not to do. Don't follow charts. Don't pay active fund managers. Don't try to time the market. Now, what should you do? Malkiel lays out a practical framework, and I'm going to break it down in a way that makes sense for everyday Americans. Step 1. Start with your life stage. Malkiel describes investment strategy as something that should evolve with your age and risk tolerance. He talks about the concept of your risk capacity, not just how much financial risk you can absorb, but how much you can emotionally handle. If you're 25 years old, you have time on your side. A market crash isn't a catastrophe for you, it's a sale. You can afford to be mostly in stocks. If you're 55 years old and 5 years from retirement, a major crash could be devastating. You need more stability, more bonds, less volatility. Malkiel's general rule of thumb, subtract your age from 100. That's roughly the percentage you should have in stocks. So at 30, about 70% stocks. At 60, about 40% stocks. Now this is a simplification, and Malkiel acknowledges that everyone's situation is different, but it's a powerful starting framework. Step 2. Diversify, broadly, globally. Most Americans think of diversified as owning 10 different U.S. stocks. Malkiel says, think bigger. True diversification means U.S. stocks, large cap, small cap, international stocks, developed markets like Europe, Japan, emerging markets, China, India, Brazil, bonds, U.S. government and corporate, real estate investment trusts, REITs. Why? Because different assets perform well in different economic environments. When U.S. stocks crash, international stocks might hold steady. When stocks struggle, bonds often rise. Diversification is the only truly free lunch in investing. Step 3. Dollar cost averaging, the strategy that takes emotion out of investing. Here's a scenario many Americans know too well. It's March 2020. COVID-19 is spreading. The market is in free fall. The Dow drops 37% in 5 weeks. Every news channel is screaming financial apocalypse. What did most people do? They sold. They panicked and pulled their money out. What did the disciplined index fund investors do? They kept buying. Every paycheck, automatically, regardless of market conditions. And what happened? By August 2020, the market had fully recovered. By the end of 2020, it was up 18% for the year. The people who panicked and sold locked in their losses and missed the recovery. Malkiel's prescription is called dollar cost averaging. It means investing a fixed dollar amount at regular intervals, say $500 every month, regardless of what the market is doing. When prices are high, your $500 buys fewer shares. When prices are low, your $500 buys more shares. Over time, this naturally lowers your average cost per share, and it removes the emotional decision-making that destroys most investors. You don't need to know where the market is going. You just need to keep showing up, consistently, automatically, for years. Step 4. Keep costs ruthlessly low. Malkiel dedicates significant energy to the mathematics of fees, and it's eye-opening. Let's say you invest $10,000 today. It grows at 7% annually for 30 years. With a 0.03% expense ratio, like a Vanguard index fund, you end up with about $74,000. With a 1% expense ratio, typical active fund, you end up with $57,000. That 97-cent difference costs you $17,000 on a $10,000 investment. That's not a small number. That's a used car, a year of college tuition, a down payment. Now imagine that's $100,000 instead of $10,000. You just gave away $170,000 in fees. The message is crystal clear. Every dollar you pay in fees is a dollar that isn't compounding for your future. Step 5. Never try to time the market. This one is crucial and almost universally ignored. There's a famous study that looked at Fidelity's best-performing accounts between certain years. The researchers wanted to see what the top-performing investors had in common. You know what they found? The best-performing accounts belonged to people who had forgotten they had the accounts, and accounts of people who were dead. They weren't trading. They weren't panicking. They weren't watching CNBC. They were just sitting still, letting compounding work. Malkiel's message is time in the market beats timing the market every single time. Research shows that if you missed just the 10 best trading days of the S&P 500 in any given decade, your returns get cut roughly in half. And those best days almost always happen right in the middle of the worst crashes, when everyone is most tempted to be out of the market. I want to spend a few minutes on something Malkiel covers that I think is the most underrated part of the book. We've talked about markets being efficient. We've talked about index funds. But here's the thing. Even if you know all of this, your own brain is working against you. Malkiel, drawing on behavioral finance research, explains that human beings are wired in ways that make us terrible investors. Let me give you a few examples. Loss aversion. Research by psychologists Daniel Kahneman and Amos Tversky showed that the pain of losing $100 is psychologically about twice as powerful as the pleasure of gaining $100. What does that mean in practice? It means when markets fall, the emotional pain is so intense that we make irrational decisions. We sell at the bottom. We lock in losses, and then we wait until the market has fully recovered before we buy back in, which means we buy back at the top. Buy high, sell low, the opposite of what we're supposed to do. Overconfidence. Studies consistently show that individual investors, especially men, overestimate their ability to pick stocks and time the market. The more we trade, the less we underperform. Research from Terence O'Dean at UC Berkeley showed that the most active individual traders underperform the market by about 6.5% per year. Think about that. The more confident you are, the worse you do. Herd mentality. Remember GameStop in January 2021? Reddit users coordinated to pump a struggling video game retailer's stock from about $20 to nearly $500 in weeks. Regular Americans poured in their savings, then it crashed back to earth. Why did they do it? Because everyone else was doing it. Because they didn't want to miss out. Because it felt like free money. Malkiel saw this pattern coming. He described it decades before Reddit existed. The herd always moves together, right off the cliff. Malkiel's warning. Your portfolio's greatest risk isn't market volatility, it's your reaction to market volatility. So how do you protect yourself from yourself? Malkiel's answer is elegant. Automate everything. Set up automatic contributions to your 401k. Set up automatic investments in your index fund. Automate your rebalancing once a year, and then put your phone down. Stop watching your portfolio every day. The investors who check their portfolios the least tend to perform the best because they make fewer emotional decisions. I know this is hard. In a world where our phones notify us about every market move, where Twitter is full of people claiming they called the last crash, where your coworker brags about his crypto gains at the water cooler, it's incredibly difficult to just do nothing. But Malkiel, after 50 years of research, is telling you doing nothing is often the most powerful thing you can do. Let me bring this full circle with a story. Imagine two cousins, let's call them Jake and Tyler. Both grow up in the same middle-class family in Ohio. Both get decent jobs right out of college. Both start earning around $60,000 a year. Jake goes to a financial advisor. The advisor puts him in an actively managed mutual fund with a 1.2% annual expense ratio. Jake watches CNBC every morning. He moves his money around when things look scary. He sold everything in March 2020 when COVID hit. He bought back in July 2020 after the recovery was mostly done. Tyler reads this book. Tyler opens a Vanguard account and puts 80% into the VTSAX, the Vanguard Total Stock Market Index Fund, and 20% into a bond index fund. Tyler sets up automatic contributions every paycheck. Tyler barely looks at his account. 30 years later, both cousins retire. Jake's net worth? Respectable. Maybe $400,000 after fees, taxes, bad timing, and emotional decisions. Tyler's net worth? Over $800,000, possibly more. Same income, same starting point, different strategy, double the outcome. That is the power of what Malkiel is teaching. It's not glamorous, it's not exciting. There are no hot stock tips, no secret formulas, no get-rich-quick scheme. Just math, patience, and the discipline to stick with it when everyone around you is panicking. The stock market is a device for transferring money from the impatient to the patient. Warren Buffett. Malkiel would add, and from the expensive to the cheap. The Wall Street machine makes billions of dollars convincing you that investing is complicated, that you need experts, that you need their products, that you need to be actively managed, because if you just bought an index fund and held it, they'd make nothing from you. Malkiel's book is essentially a 400-page argument that the simplest approach wins, and after 50 years, the data overwhelmingly proves him right. All right, guys, let's land this plane. Here's what Burton Malkiel wants you to walk away with, and what I want you to remember from this video today. 1. Stock prices move randomly in the short term. No one, no analyst, no algorithm, no guru can consistently predict them. 2. Both technical analysis and active fundamental stock picking fail to consistently beat a simple index fund over the long run. 3. The market is mostly efficient. By the time you hear about a hot stock, the opportunity is already priced in. 4. Market bubbles are real, recurring, and inevitable. Human psychology drives them, and it will always drive them again. 5. The solution? Low-cost, diversified index funds, dollar-cost averaging, long time horizon, automatic investing, and the patience to do nothing. 6. Your biggest enemy isn't the market, it's your emotions. Automate, detach, stay the course. This book was first published in 1973, over 50 years ago, and its core message has only been validated more powerfully with every passing decade. If you've never read it, go get it. It's one of the most important financial decisions you'll ever make. I'll link it below. And if you found value in today's breakdown, smash that like button. It genuinely helps this channel reach more people who need to hear this message. Subscribe to Mono Invest if you're new here. We break down the world's greatest finance books and investment concepts in a way that actually makes sense. Drop a comment below. I want to know, are you currently in active funds or index funds? Let's talk about it. Until next time, invest smart, stay patient, and let the market do the work. I'm Mono. Peace.